Welcome to this explainer. Today, we're going to completely demystify investing using a concept that we all intuitively understand: building a house. We're looking at the ultimate architectural blueprint for a lifetime investment portfolio. Just 5 essential pillars that will help you build a resilient, totally weatherproof financial structure.
Okay, let's dive into this because, listen, if you've ever felt completely overwhelmed by confusing financial advice, you are definitely not alone. Our source material perfectly hits the nail on the head here. I've watched people overcomplicate this so much. It's so true, right? The financial world honestly thrives on making things seem vastly more complex than they actually need to be. But today, we're cutting through all that noise. We're going to look at a straightforward 5-pillar solution that you can theoretically just buy and hold forever.
So here is the literal blueprint for our build today. First, building your financial house. Second, expanding outward with global diversification. Third, the income layer. Fourth, the safety net. And finally, the ultimate asset. You'll know exactly where we're going every step of the way.
Let's start with part 1, building your financial house.
Every single solid structure out there has to start with a concrete foundation. I mean, you wouldn't dream of framing the wooden walls before you've actually poured the ground level, right? Well, investing is the exact same way. You need a rock-solid, reliable base before you start adding anything else to your portfolio. In the financial world, pouring that concrete, which is exactly what we're doing right now, means anchoring yourself to the broad U.S. stock market. But how exactly do we do that?
And this brilliantly illustrates our 2 absolute best tools for the job. On one side, you have an S&P 500 fund, like VOO. This tracks the 500 largest publicly traded companies in America. It gives you instant exposure to giants like Apple, Nvidia, and Microsoft all in one go. But then, on the other side, you have the total U.S. market, like VTI, which goes a step further. It holds those same 500 massive giants, but it adds roughly 3,000 mid-cap and small-cap companies to capture literally the entire market.
Now, you might be wondering, why do these choices make such great concrete for our foundation? Well, because historically, over the long run, the returns of these 2 funds tend to converge right around 10% annualized. Over short periods, sure, one might slightly outperform the other, but over decades, they act very similarly. They provide that essential, steady growth base for everything else we're about to build on top of it.
Moving right along to part 2, expanding outward with global diversification.
So the concrete is poured. Now we are framing the walls. But here's the thing. A lot of investors actually drop the ball right here, building a portfolio of just U.S. companies and calling it diversified. That's kind of like saying you've tried every type of food in the world, but you've only eaten at restaurants within a 3-mile radius of your house. You're completely ignoring the rest of the globe. The solution here is a total world fund, like the VT ETF, capturing the entire global stock market. It holds roughly 9,000 companies. It's weighted about 60% to the U.S. and 40% to international markets. So you're getting developed nations like those in Europe and Japan, plus emerging markets. And this matters because there are long stretches in history, like the 1970s and the 2000s, where international markets significantly outperform the U.S. So when U.S. stocks struggle, these international holdings step up to balance the load and keep your walls standing strong.
And here is the truly amazing part about this. To get this global, automatically rebalancing portfolio, the expense ratio is a mere 0.06%. To put that in real-world terms, it essentially costs you just $6 a year for every $10,000 you have invested. $6! It is an incredibly cheap way to buy literally the whole world.
All right, part 3, the income layer, focusing on dividends.
So we have our foundation, and we have framed our walls. Now, let's put a roof on this house. For this, we look at a dividend-focused ETF, like SCHD. This acts like a protective roof, bringing in steady cash flow. It's built entirely out of high-quality U.S. companies that have long track records of not just paying out dividends, but actively growing them year after year. Look at some of the top holdings you get here. Texas Instruments, Qualcomm, Coca-Cola, Verizon. Are these the flashy, exciting tech names that are going to triple overnight? Absolutely not. But they are incredibly reliable. These are the companies that have consistently written checks to their shareholders through thick and thin, through major recessions, global pandemics, and aggressive rate hikes.
So, the crucial point is understanding the tangible benefit of this income roof. With a dividend yield hovering around 3.22%, if you were to have $50,000 invested in this fund, you're collecting roughly $1,610 a year in dividends.
That money just magically lands right in your account simply for holding the shares. You can either use it to pay some bills or reinvest it so it compounds even faster over time.
Section 4. The safety net. Let's talk about cash.
Okay, the main house is completely built. But what happens when severe weather hits? We need a storm shelter. Now, most people make one of two major mistakes with cash. Either they have no cash reserve at all, meaning the second life goes wrong, they are forced to panic sell their investments, or they have way too much cash sitting in a traditional checking account, earning something pathetic like 0.01%, leaving real, meaningful money on the table to get eaten by inflation. This brings us to a specific type of ETF, like SGOV. SGOV holds ultra-short-term U.S. government debt, specifically 0 to 3-month Treasury bills. In the finance world, this is literally considered a risk-free rate. It's the ultimate liquid defense. Yielding around 3.5% net after a tiny 0.09% expense ratio, it ensures that your emergency money isn't exposed to stock market volatility while still paying you enough to protect your purchasing power.
Plus, there is a massive hidden benefit here that you absolutely need to be aware of. The interest earned from these U.S. Treasury securities is generally exempt from state and local income taxes. If you live in a high-tax state like California, New York, or New Jersey, that exemption is highly material. It makes the effective after-tax yield on this cash equivalent significantly superior to many standard high-yield savings accounts or money market funds.
And finally, Section 5, the ultimate asset, yourself.
Now, what's really interesting about this slide is itself is obviously not a real ticker symbol you can buy in a brokerage app. We've poured the concrete, framed the walls, attached the roof, and dug the storm shelter. But there is one final, critical piece to this entire blueprint. It is the absolute most important, yet frequently the most neglected layer of any lifelong portfolio. This represents the architect who designs, builds, and funds the entire blueprint, you.
You know, investing in yourself isn't just some cheesy motivational speech. In our source material, the host shares this fantastic anecdote about starting his finance channel back in November 2017. He bought a massive whiteboard off Craigslist, literally strapped it to the roof of a Subaru Outback in freezing Cleveland weather, basically got frostbite in his hands driving it home, and then just started teaching to a camera. For a year and a half, he grinded and didn't make a single penny. Nothing. But that initial brutal grind led to an incredible self-made career because, as he put it, you need to figure out something that you're passionate about. He had an itch to be a financial planner that his day job just wasn't scratching, so he invested time into his own niche. Whether it's taking a course, starting a side hustle, or learning a completely new skill, if you are unfulfilled by your day job, your greatest return on investment will almost always come from investing your own energy into yourself. So, looking at our completed build, we have a solid U.S. foundation, a global frame, an income-producing roof, a secure storm shelter, and a highly capable architect. This beautifully structured financial house gives you a system. It prevents you from just throwing money around and gambling blindly. And most importantly, it proves you don't need to overcomplicate things with 100 different funds to be incredibly successful over a lifetime. We have successfully simplified the financial blueprint for your portfolio, but the construction simply cannot begin until the architect gets to work. So I want to leave you with this provocative question to ponder today. What is the very next investment you will make in yourself? Thank you so much for joining me on this explainer. Keep building your knowledge, and I will see you next time.